For Morningstar, I'm Jeremy Glazer. I'm here with Chris Goolgasian. He's the head of portfolio management of the Investment Solutions Group at State Street Global Advisors. Chris, thanks for joining me.
Thanks, Jeremy. We appreciate it.
Let's start with looking for income. You obviously manage a fund that's out there looking for income, that's allocating to different ways of finding it. Investors have been searching high and low for it. Yeah. Are there any places left, any stones that haven't been overturned?
Yeah, that's a good question. And I think the old line that comparison is the death of happiness is a great way to describe the landscape that investors find themselves in today. I feel like investors think that there's something they don't know about, and they're just searching to find out about it. It's like they think there's a big secret, but there isn't. Everything is unattractive in the yield space. And it's a relative world where you have to find the ones that are slightly more attractive in a space that in general is not attractive. And I think if investors can embrace that idea, they can avoid some of what I've termed the optimistic unknown, which is searching and being optimistic for higher yielding product that's really unknown to them and how it's constructed and how it works. That's a recipe for disaster.
So what does look more attractive on a relative basis?
Yeah, so for our income slanted portfolios, we've been significantly overweight dividend-paying equities, which on a number of metrics are significantly more attractive than the entire fixed income landscape. Now, within fixed income, we've preferred credit over treasuries. The spreads have certainly tightened and are no longer as attractive as they have been, but still there's a little something there. We've also preferred something that most of the marketplace really does not like, and that's the long end of the curve. And the long end of the curve is a great diversifier to holding dividend-paying equities. So it helps to reduce volatility. In a year like this, it also has an added benefit of long end has had a really good run. But the marketplace is generally short duration. People think rates are going to rise, and they're going to rise quickly. And people have had no appetite for the long end of the curve. Everyone wants to move shorter on this big worry about interest rate move increases. And certainly that is going to happen someday. We're not so sure it's going to happen imminently. But in the meantime, you get much more carry on the long end. And from a diversification standpoint, it is a terrific diversifier to holding this extra equity because the long bond is a great risk reducer to that equity position.
On the other hand, what doesn't look very attractive right now?
So we've been underweight high yield, and our perspective is on a risk basis, we certainly prefer equity, dividend-paying equity over high yield. Equities are reasonably valued, and we think high yield is overvalued. And generally, high yield tends to act like equity, especially in riskier markets. And on the equity side, you have the potential for innovation and growth, and a yield that is also at times pretty healthy too. And now you have high yield with a spread that is extremely low, absolute yields that are very low, very little upside, and of course being a fixed income instrument, no ability to innovate and grow and all of that. So we've been, within our tactical positions, we've been underweight high yield and overweight the dividend payers.
Let's turn our attention to inflation. We had maybe a little bit of a scare in spring, things looking slightly better in recent data. What's your view on inflation? Is it going to be a major problem?
So inflation does not look like any type of imminent problem, and for the skeptics of CPI calculations, even when you look at other non-governmental calculations, for example, there's the Billion Price Project, which looks at internet prices and compares daily prices with a history of a basket of goods. And when you look at the inflation implied in that versus CPI, it's really no different, which is to say near zero. And so we don't think that, even if you're skeptical about the government's construction of CPI, we don't really think that there's any imminent danger of inflation here. But that's not really the issue for real asset investing and inflation investing. You should be designing your portfolio for the potential in the future. And I think people are too concerned in the real asset space about what's going to happen in the next couple of months. They're losing the long-term view of how do they protect the portfolio with some type of insurance quote on inflation for the future. That's really what you need to think about. And from our perspective, some type of allocation to real assets on the optionality of Fed-induced inflation or growth in the economy that causes inflation makes sense now because there are parts of the real asset environment that look pretty cheap on a historical basis.
So on that front, what would you recommend? Something like gold being an option today?
So gold is certainly something that we've held. Historically, we do hold it now as well. Gold is, I think, falling under a very simplistic narrative in the marketplace today. So the narrative goes like this: the U.S. economy is improving, rates are rising, the dollar's getting stronger, gold's priced in dollars, and for other reasons as well, just around growth, gold is going to weaken. And that is basically the byline you see in every news story when gold sells off. You get basically that narrative. That narrative seems to me very simple and likely not the truth of what's going to happen in the future. You know, Japanese have moved to full QE. Draghi and Europe are going to move to QE from all signals that they've sent in the last few months. And I think if we had an outpost on the moon, there would be moon QE too, right? The world and the central bankers have adopted a QE framework. And while the US is certainly slowing that down, there's no doubting that the world and the genie of QE is out of the bottle right now, that this is the go-to move. And my view on that is that's likely going to lead to a policy mistake at some point, and likely lead to some major currency upheaval at some point. And one of the best ways to hedge against that is gold. And you know, we have a lot of discussions with clients, and there's a belief out there that, you know, well, don't you think that the central bankers really helped boost the economy and get everything going again? And you know, part of the answer to that is we don't know the counterfactual, right? You'll never get to run the 10,000 stochastic simulations and see what would have happened if they didn't do QE. And so all you can do is think about, you know, if someone was on a desert island for 20 years and came back and said, how are things going? And you said, well, GDP is growing at 3%, unemployment's under 6%, stock market's at all-time highs, trading at 16 times earnings, reasonable valuation, ISM numbers were just at 10-year highs, et cetera. The person will say, wow, that's pretty good. What are interest rates at? Oh, they're at 0. And your next question will be, well, how could that be? And the answer would be, well, the people who put interest rates at 0 think that that's the reason all of that happened. And we'll never really know that, and I'm not sure that that's the case. But the point is that the central bank philosophy now is that they can dramatically impact the world through these aggressive QE maneuvers. And one of the only ways to really hedge against that becoming a mistake is through gold.
Well, Chris, I certainly appreciate your take on the markets today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.